Right, there we go. Well, good morning, everyone. Welcome to the University of Stellenbosch Business School Career Conference. This morning, our first presenter is Nico Kutsia. He is from PPS. And Nico has 13 years of experience in the financial industry. He's worked as an investment analyst. He's set up retail and institutional business development for large multinationals. He's been the founding member of the senior management team at PPS Investments. And now he's set up a new generation financial planning business for the PPS group. So I hope you enjoy this presentation, and we'll see you later. Thank you, Nico.
Good morning, everyone. Just face this way, seeing that everyone decided to sit on bike this morning. Thanks very much for joining me. It's a privilege to talk to you this morning. I realized that when I was up against Andrew Bramley, it was going to be tough going. But I think the purpose of my talk today is to try and simplify financial services. I think it can be quite a complex industry to try and understand and try and navigate. And especially when you're looking at it from a career perspective, we often find that when we interview people, they apply for positions without really understanding what the role entails. So my presentation is relatively short. I don't have a lot of slides. I don't want to bore you to tears, so I'm going to go through it. And if you have questions, because we're a smaller group, I'm quite happy to take questions. And if we finish early, I'd much rather have a conversation with you and talk about financial services. Like Edith said, I've been privileged enough to have been involved in a number of different parts of the industry. So I've worked in a number of different businesses, but also in different departments. So although I'm not an expert in all the departments, I'm quite comfortable taking questions on any specific role in the broader financial services industry. So I've got three main things I want to cover. First of all, why a career in finance, which is literally just one slide. Then I want to get into the financial services system, spend quite a bit of time on that. And then I want to talk about three new roles that have developed in finance, probably in the last 3 years or so. And that's really been driven by some global trends that we've seen coming into the market that's changed the way that businesses are structured, and that's led to new opportunities coming into investment companies especially. I'm also going to give an example of an actual vertically integrated investment business and show you the different roles in that business to try and make it a bit more practical and less theoretical. So why do people go into finance? Generally, when people think about finance, they think it's all about making money. It's generally a very nice industry to work in. You work with very good people, you work in a nice environment. But what we also see is we find people from different professions coming into financial services. So if you take the PPS group, for instance, the person that heads up the life advisory or the life sales division is a geologist. The person that is the group CEO actually has an HR background. The CEO of the investment business studied engineering and then ran hotels for 10 years, then an MBA, and then started working for Coronation. So we find lots of people with different backgrounds working in financial services. Obviously, a lot of CAs, especially in the investment part of the business, because you've got to understand balance sheet if you want to manage money. A lot of lawyers, and interesting enough, a lot of lawyers in the distributions part and the business development part of the industry as well. So regardless of your background, financial services is a very nice industry to find a home. But let's get into it. So basically, there are three broad entities in the system. So I'm not going to sketch the economic system for you. I think we've all done economics 101. What I want to try and do is just look at the three broad entities that participate in the financial services industry. Basically, we have the client in the middle, we have advice around it, supported access, and then the manufacturers at the outer end of the circle. So what I want to do today is actually look at each one of these entities and sort of break it down, look at some of the roles available within these categories. But what I also want to do is bring a little bit of the psychological aspect into it. So look at some personality profiling and use the insights profile, and look at what personality preferences suit the different roles. So not just looking at the roles that are available, but given your specific personality preferences, what are the roles that would be more suitable to you than others? Obviously, we are all human, so we are able to adapt ourselves to our situations, but there are obviously certain personality profiles that are more suited to certain roles. We try and bring that in as well. And then also look at some of the trade-offs that people make when deciding which way to go. I've got a very basic system that I use, so you can either, this is the insights wheel, so you can sort of look at that to get a sense of generally which one of those colors you would be. So you can either be a cool blue person, it's a very formal, process-driven, very accurate, takes a while to make decisions, very analytical, or a fiery red person, which is it's an extroverted person, but there's a tagline for those personalities of be brief, be bright, be bright. If you're one of those, that could be your personality preference. Likes productivity, hates loss of control. Lots of CEOs are fiery reds. You can be a sunny yellow, which is very outgoing. Fears the loss of prestige, wants to be admired, it's all about recognition. Or then your earthy green, which is the show me you care people. So you care about the community, those around you. You don't like confrontation, and you value relationships above anything else. From a trade-off perspective, depending on the path that you take in financial services, there are certain trade-offs. So if you want security, often you will have to compromise on flexibility. If you want money, sometimes you will have to compromise on career path. So, and I'll go through the roles and I'll try and highlight what the different trade-offs are. Obviously, if there are any roles that you're specifically interested in that you would like me to discuss in more detail, then we can go through it. Okay, so if we look at the first entity, which is the advice, and generally speaking, this part of the industry deals in assisting people with making decisions. Okay, so they are the closest to the client. And then we have a number of different roles. So we have bankers, we have agents. These are your 5 agents, people that are linked to specific product providers that essentially market their products. You have the so-called IFAs or independent financial advisors, the brokers in the market. You have wealth managers, financial planners, which is sort of the next evolution of the advisor, stockbrokers and consultants. Now, generally speaking, people that operate in this part of the industry are sort of green and yellow, so they want flexibility, also care about money. This is where you can make really big money if you're a successful business development person. Generally speaking, people suited to this role, to these roles are more outgoing, so your sunny yellow personalities, or your earthy greens that are able to express empathy in terms of the people that they deal with. And there's a very interesting Harvard Business Review article that talks about what makes a good salesman. And essentially, there are 2 things. It's empathy and drive. So you have to be able to empathize with people and put yourself in their position, but you've also got to have enough ego drive to, strangely enough, not really care. It's actually about you closing the deal. And I've definitely seen this having managed sales teams in the last 10 years or so. You find people that are excellent at building relationships, but they make terrible salespeople because they don't have the confidence to go to that next step. And then you get the opposite as well. People with a lot of drive and absolutely no empathy. Generally speaking, my experience, they actually make better salespeople. They're not very nice to deal with, but they are quite successful. This part of the industry is gaining power. There's a big global power shift that's happening from the product manufacturing part to the advice part. And really, that's linked to another big global shift, which is the empowerment of the customer. I'll talk a little bit more about that later. You'll see when I look at some of the new roles coming into the industry. It all relates to this global shift. The person that's closest to the client, the person that's advising the client with the decision making, is actually in control of a number of things. So that person will going forward be more secure in terms of maintaining their profit margins, their earnings. Whereas the other entities in the value chain, the other 2 that I'm talking about in a second, because they're disintermediated, it's becoming a lot more challenging for them to sustain the earnings that they've generated in the past. The other big thing that's happened, there's also been a professionalization of people in this part of the industry. So if you go back 20, 30, 40, 50 years, the people that provided advice in South Africa, especially in the insurance and investment markets, were generally people employed by product providers to sell their products. They weren't necessarily people that started thinking about the client and looking at what the best outcome is for the client. It was actually more about how do I sell you the product that I'm representing as opposed to how do I get you the best outcome? And that's led to a number of, let's just say, bad things coming into the industry. So products that are not necessarily transparent, products that are very expensive, products that are very rigid, so you get locked in, you can't really move. The regulators obviously taken notice of that, so they started to intervene. So going from a substance to a form-based legislation with people who it's not just a case of you ticking a box. If your intentions aren't clear, the regulator will still know you. So we have things like TCF, we have the retail distribution review that's coming to the market that will fundamentally change the way the financial services industry operates. And really the big goal is to actually change it from an industry to a profession. So we talk about the medical profession, and we talk about the accounting profession, and we talk about the financial services industry. This sort of gives you an idea of how this thing works. So an industry is a place where you manufacture things and you sell them. Profession talks to something else, talks to a service, quality of the service that you receive. So this whole professionalization, especially in this part of the industry, is all about shifting. So actually getting people that assist with decision making, that focus on the client first, as opposed to on the product side. We'll talk a little bit more about this later. So this is a growing part of the industry. It's a lot of people are actually shifting from the other two entities, or other two categories, the sort of enablers or the administration and the manufacturing parts into the advice part. There's also a lot of the other functions that are starting to shift into this part of the industry as well. So if you look at what's happened in the UK post their RDR implementation, the retail distribution review, they actually talk about the death of stockbrokers. So the whole concept of the stockbroker is sort of fading, because what's been happening is the professionalization of the financial planners and the IFAs forced them to upskill themselves to a point where actually they can now fulfill the same role as the traditional stockbroker. So if I'm starting to manage model portfolios, I'm constructing portfolios using mutual funds or collective investment schemes, it's actually not that complicated to just take the next step and then manage shares as well. And what you've seen, especially on the stockbroking side in South Africa, and maybe actually a little bit ahead of the UK, is the institutionalization of the investment processes. So the old days, your stockbroker was your sort of typical gunslinger. Every guy gets their own portfolio and they can win a deal. But now if you look at the way that these stockbroking firms are being run, they actually have model portfolios, and then the stockbroker has some discretion around the model portfolio based on that person's seniority. So if we take practical examples on Empower Wealth, which is one of the more successful businesses in South Africa, we have a partnership with them on the TPS Investments platform. They have model portfolios, and the stockbrokers in that business can then change those portfolios or make them more customize them for individual clients, 10, 20, and 30%. So they can change the shares up to 30% for most senior stockbrokers in that business. But if you think about it, that's actually not that far away from just a normal institutional asset manager. So the idea of stockbroking is sort of a consolidation between your wealth manager, your financial planner, and your stockbroker, where in 10 years' time, that's probably going to be one and the same person, as opposed to being potentially 2 or 3 different people. So some of the roles available, you have sales representatives, although no one calls their salespeople anymore. They're called consultants or specialists or business development managers or anything that's not sales. Even the word consultant is falling out of favor. So BPS is an example. We've recently decided no person that works in sales will be called a consultant anymore. We will find better titles for them. Financial advisors and then business development managers. Generally, when you're engaging with a salesperson on the investment side, they refer to themselves as business development managers. And they either engage directly with clients or they engage with the intermediary that deals with the client. Yeah. So that's the first entity. Like I said, this is where a lot of the action is starting to happen. I mean, last week, busy setting up this sort of new generation financial planning business. I had portfolio managers from asset managers going for interviews, which has never happened before. People generally wanted to get into finance to portfolio managers. Now portfolio managers are saying actually work closer to where the clients are. The next level, which is sometimes a little bit more tricky for people to understand, is essentially the bridge between the person that assists the client in the decision making and the person that manufactures the product. Okay, so the easiest example that I can use is your platforms, or they're sometimes referred to as lists or unit trust supermarkets. So 15, 20 years ago, if you wanted to save some money in a unit trust, you would go directly to Simon or Mutual or Coronation and buy unit trust from them. Nowadays, it doesn't work like that anymore. The way it works now is you generally go to a financial advisor, who then goes to a platform, a unit trust supermarket, where they offer a range of different funds, and he selects the funds on that platform. The platform then goes and actually invests the money with the asset managers. Okay. So the platforms have been a very big thing in South Africa. It's still a huge thing in the UK. So some names of platforms would be, Alan Gray has one, Investec, Glacier, Momentum, PSG has one, PPS Investments has one. So they're the people that sort of go between the advisors and the asset managers. This also includes things like the regulator, the industry bodies, software providers. And software providers do things like provide performance and risk tools to asset managers. You also get software providers that provide financial planning tools to the advisors. This has also been a growth area, actually, especially on the compliance side. So about 2 years ago, I worked in the UK for a software company, and we engaged with a number of investment firms. And at that stage, some of those firms were telling us that actually we're getting rid of our performance teams and our risk teams because we have to employ more compliance people. Because there's just this flood of compliance that's coming into the world, and especially into South Africa. So there's a massive need for people with a legal background that can relate that in the financial services system. Obviously, things like finance, boards of trustees, this is where people like retirement fund trustees also sit. So they people that are actually making the decisions as to which managers are available, where money goes should people die. So this is where the developers sit, operations managers, compliance officers, they sit in this part of the market. Generally speaking, these are your cool blue and your fire red people. Very analytical, very decisive, and a career in this part of the industry is more secure, it's a more stable career path, and there is progression. Whereas in the previous one, generally speaking, there's not a lot of career progression if you go into a business development role. Not like you sort of can work your way up working. There's sort of 2 or 3 positions, and then when you get there, there's not much further you can go. So you really go into those roles more from a financial incentive perspective, because that's where the upside is. Whereas in this role, you can work your way through the system. The next part is the product part. Now, this is generally speaking where things are built. So I think people are more familiar with this part of the industry. This is where you have your banks, your long-term and your short-term insurers, your asset managers, your medical aid administration schemes, where your product development sits, your training as well. These are the people that work in the business that think about what the products are, that they need to build, train people on it, market them, put the brochures and things together. This has historically been where most of the power in the industry is on the product development side, on the product manufacturing side. So this is where we have massive companies in South Africa. So we have the large life insurance businesses, we've got the large asset management businesses as well. And then if you think about investments specifically, there's been an absolute proliferation of asset managers in South Africa, which is typical sort of late bull market behavior. We see this every couple of years. 2008, we have the global financial crisis. Pretty much half of the boutique managers get taken out, all portfolio managers. They don't disappear, by the way. They go and work in the big companies. Then the market starts performing. Okay, I don't want to work in a big company anymore. I'm going to set up my own boutique firm. We suddenly have all these new investment managers coming into the market. Now, it's not necessarily a bad thing, but you do find that if you look at some of the pricing and you look at some of the investment processes on the market, they are not as rigid as some of the people with the longer track records. So what generally tends to happen is, and if you look at where the market is now, the market starts coming down, we will see some of these firms either consolidating or just disappearing. We have actually seen in the last 2 years or so some of the smaller value managers in South Africa capitulate. I won't mention names, but it's very obvious if you keep up with the press that the couple of guys have either been bought over, or they've gone into joint ventures, or they've just gone extremely quiet, so you never hear about them anymore. So it's been tough times for value managers. Whereas suddenly we're now reading articles in the press about why momentum is a wonderful investment strategy, and why a PE ratio of 106 for us perhaps is actually justifiable. And it's a little, if you've been in the market for a while, you get a sense of deja vu. So I've heard this before. Sounds a lot like the dimension data articles we read in the late 90s. So we are seeing some of that in the market as well. These guys are under pressure. So if we look at the overall ability of people in this part of the industry to maintain their earnings, it's becoming very challenging, especially for the guys on the active asset management side, because we've seen passive managers coming to the market. So people like Tenex, people like Satex, the DB trackers, a number of providers are coming into South Africa. We are way behind the rest of the world in terms of using passive strategies in our investment products. The rest of the world, in the States, for instance, the vast majority of savings and retirement funding actually goes into passive strategies, not into active managers. Less so in the UK, although they've seen a massive pickup there. In South Africa, we are definitely going to see that trend coming into the market as well. Which obviously, if I could buy a fund that gives me the market returns for 20 basis points or 0.2%, why would I go and pay another guy 1.2% if he's not really giving me outperformance above the market? A lot more people are going to ask those questions. In South Africa, we tend to have better managers, generally speaking, on the active side. So we actually have some quality people in this market that deliver very large, long-term alpha on a real basis. From a non-investment perspective, if we look at what's happened with life insurance companies, sort of a much of a muchness, to be quite honest. So the products that we see today are actually not that dissimilar from the products that we saw 20, 30 years ago. In fact, some of the new guys that are coming into the market are doing very old things, but with much better packaging. So it looks like it's shiny and new, but actually it's not that different from stuff that was together 20, 30 years ago. So this part of the industry is really there. This is also where you can really build a career. There is quite a bit of money in this if you go onto the asset management side, even product development, marketing, you can build a good career here. Generally speaking, for more analytical people, also more red-type people, so being able to make a decision, taking time to analyze before you make those decisions, that's sort of more suited. This is where we find the actuaries, the portfolio managers, marketing managers as well. Marketing is quite interesting in financial services. So generally speaking, marketing in financial services is relatively different to marketing in other industries. It is a lot more conservative, I think, than what we see out there. So it's very rare that you see two financial services companies really going at each other in the press. Very different to the UK, where they actually nail each other on TV. We're very respectful here. We also have advertising codes of conduct that actually prevents us from nailing each other, and even doing things that you can't even do comparisons actually in South Africa. It's, you have to, the other person that you're comparing against has to agree that your comparison is correct, and often that just doesn't really happen. Okay, so those are the sort of three main things with some of the roles that are available around it. One of the big things that's happening, not just in South Africa but globally, is this idea of vertical integration. So if we have those three parties, people would generally, or businesses would generally specialize in one of the three. But because there's been an overall focus on forcing down the total cost of ownership, more businesses have started integrating with other parts of the industry as well. So I'll use a couple of practical examples. I'll do it from both ways. So you can go that way or that way. So if you take PSG, for instance, that's quite a good example of a business that actually, and I'm talking about PSG Consult specifically, they really specialize on the advice part, so really owning the relationship with the client. So PSG Consult Financial Advisor Didn't have any limitations in terms of whose products they could advise on. They were independent. Okay? They then did a very, very good job of actually growing PSG Consult into the largest independent financial advisory firm in South Africa. Okay? What PSG then decided is, okay, so we have the relationships. Making money in advice is actually fairly challenging. The margins are a lot better in that part than they used to be better in that part, although that's not the case anymore. So what PSG said is, well, let's get ourselves an asset management business. So they bought the Appleton business years ago, and that became PSG Asset Management. So now we give our advisors the option of using PSG funds. We also set up our PSG multi-managed funds. So instead of the advisors picking the funds, we will pick them for them, but then obviously charge an additional investment. The next thing they did is they said, okay, well, let's get ourselves a platform. So just in case our funds underperform, we don't want the advisors switching the money out and then going to them from there. We'll actually give them an administration platform that will offer the PSG funds along with other funds. Okay? So then when they switch, they can switch to other funds. We still make some of the margin on the administration. So that's now become a proper vertically integrated business. The other example I want to use that's gone the other way is PPS Investments, a business that I've been involved with. When we started, we only had an asset management, we had a multi-manager. We then added a platform business, and later we then added an advice business. So what we've seen in South Africa is a lot of the people in the product space have been going to this space. They've been either buying stakes in financial advisory firms. And the reason why they've done this is because they've effectively been disintermediated. So like the example I used earlier, when you wanted to invest 15, 20 years ago, you as a client went directly to the product manufacturer. What's been happening now is now you go through an advisor and you go through a platform. So if I'm the guy sitting over there, I've got a really amazing fund. How do I get into the fund? I have to actually work through these guys. So probably the most successful distribution strategy on the investment side in the last 10 years has been Coronation. And the reason why Coronation has been so successful is because they haven't actually focused directly on the client. They've built excellent relationships with all the platforms that offer the number of different funds. And their salespeople have essentially been selling the Coronation funds to the advisors. Okay. So that's why Coronation's obviously been doing well because of the massive brand presence. But in South Africa, something like 85% of all flows go into 20 funds, unit-trust funds. I don't know if you know, we have 1,200 funds in South Africa. 85% of the money goes to 20. The other 1,180 guys share about 20% of the flows. Okay, so if you want those activities, if you want to get to that client, you can either try and compete with the other 40 managers in the market, or you just get your own advisors to sell them for you. So that's what a lot of these product providers have been doing, is they've been getting into advice, and the advisors have been going the other way. So they've been saying, you know what, actually picking these funds is not so hard, because it's a bull market, the market just been going up, so pretty easy. So what I'll do is I'll get myself a license, it's called a Category 2 Discretionary Management License, which then allows me to manage money. Okay, so I'll go and construct model portfolios, and I will then charge people an additional investment management fee on top of my advice. So that's where vertical integration has gone the other way. So they've been getting into the product manufacturing space. If you look at what's happened in the UK, the overall cost of ownership to a client has actually come down. It has come down post the regulations, post the retail distribution review. But what's happened is this part, the fees in this part, have actually gone up. Because what's happened is now the regulator says people have to pay this. Cool, I'm the advisor, what am I going to do? I'll find the cheapest platform. Instead of paying 0.6 for a unit trust platform, I'll go and find one where I pay 0.3, where my clients pay 0.3. And instead of using active managers, where my clients pay 1%, I'll go and find passive managers where they'll pay 0.3%. So now I've saved my client 1%. And the reason why I can do that is because I control the relationship. So that's actually what's been happening in the UK. And if you look at what's been happening in the States. In the US, I read an article this week They surveyed 1,000 RIAs, registered investment advisors in the States. And of the 1,000, 90% of them have doubled their earnings since 2009. So these guys are actually making more money. The people over here are battling to sustain their margins. And that's why we've seen this thing. You want to be in all the different parts of the industry. But now from a regulator's perspective, it gets a bit complicated. So the guy that's sitting in front of you, that's helping you make the decision, do you know that he's linked to that guy over there? Because he's telling you he's independent, but is he really independent? If that guy owns 50% of his business. And that's why the regulator's coming in and saying, no, wait a minute. You guys are not disclosing who you really are. You've got to tell people that I am going to sell you one of those products because it's part of my business. That's all, this whole disclosure issue. So this is a typical investment business. This is what it looks like. This is a vertically integrated business. So this is a business that operates in product manufacturing, access, so a platform business, as well as advice. And what I thought I'd do is show you just the senior management structure and then sort of highlight the personality preferences of the people that are in those roles. So you'll see, like I mentioned earlier, generally you'll fire a red that has to be able to make decisions. Your executive finance, they're generally blue people. Your accountant personality. Your governance people are generally red people, so that's where your compliance sits. That's your finance, your head of investments, and then that's where the analysts sit in the business. You have your sales and marketing, and there you generally have people that support direct clients, so your client advisors, and then you have people that support the independent financial advisors to ensure that those guys also market your products. This is where your marketing manager sit, as well as your communications manager. You have your product development with your analysts or your product developers. Business solutions, that's your sort of ITIS. That's where you put your developers, your business analysts. A lot of the business analysts is purely just to translate what the business wants to the IT people. Your executive operations, so that's where your client services manager falls in, your actual administration people sit in that part of the business. And then your human resources and your learning and development. This is now referred to as not training anymore, it's not learning and development. And that's generally this is what an actual business looks like. Obviously below that, you have your next levels of people that do work. Okay, so let's talk a little bit about some new roles in finance. This was a study done by KPMG in 2013 called Valley Ventura. And they say, well, given that this big shift where the customer is becoming more informed, so people are way more informed now than they were 30 years ago. I think my own parents, when they bought any financial services product, it was purely done on trust. And we can actually still see this in the product design. So if you go and look at some of these traditional reversionary bonus type products, I mean, I actually had a session with one of the actuaries in this large life company, and I said, please explain to me how this works, because I can't figure out how this thing that I've invested in relates to the market. And I said, well, it's because it doesn't relate to the market. Basically how it works is you give your money to us, we'll manage it, and then at the end of the year we'll give you a bonus. But I can't tell you exactly how that bonus works. And I mean, people don't roll those products anymore. Nowadays, I want to know exactly where my money is invested, who's managing it, and what am I paying. Okay, so the power has sort of shifted from the product manufacturer to the customer. The other big thing that's come out is that the customer is not a distribution channel. So we are people. That means that for some things we may decide to buy things directly from the manufacturer, but for other things we want advice. And that's a big conflict that's going on at the moment in the industry. So where do I put this guy? Is he a guy that I deal with directly, or do I have to deal with his advisor? So that's also, and this is where things like robo-advisors, I don't know if you think about them, simplified online advice coming into play. Okay, so what is this so-called, so if the customers, if there's a shift going to the customer, what does a customer-centric business model look like? So first of all, you have to know more about the customers. Okay? So you've got to understand the needs of your customers, your clients, and then develop the propositions to match. You have to use modeling and predictive analysis to try and target and cross-sell, and that really talks to market segmentation. You can't focus on, you have to be quite specific about where you want to play and where you don't want to play. You've got to offer the right propositions at the right time. So that talks to, maybe I want to buy my short-term insurance directly, but actually for my investments or for my estate planning, I want an advisor. So don't try and sell me short-term insurance through an advisor and sell me estate planning directly. You have to talk to me differently for different needs. You have to think about your distribution in terms of what is the optimal distribution per segment. So that's what I was referring to earlier. And then think about the servicing as well. Okay. So these things have given birth to sort of 3 new roles. And these are actual roles that we are actually recruiting for. So the first one is the so-called lifestyle financial planner. So this is a person that actually puts the client's outcome first. This is not someone that's going to try and sell you something. This is someone that's going to try and understand what your financial needs are, do an assessment of what you currently have, and then basically bridge that gap. And that may or may not mean the purchase of a product. But it's not someone that's selling something to you. It's someone that's trying to understand you and then identify where you need assistance. It's also not this, so it's important. There's a very important distinction. Someone that's not necessarily linked to the sale of the product, that will take time, that will spend time with you, because the way that they incentivize is not necessarily linked to commission or advice that they get when they are committed to the product. The next one is the so-called customer experience manager. So this is a person that actually represents the customer in business. Now, a lot of these things sound pretty basic. You could ask, well, why don't they exist? The fact is they don't. Because we come from a very product-driven environment where, it sounds terrible, but the customer is a distribution channel, and he's the guy that's going to buy my stuff. So this person makes use of things like CEM type software. So this is where you start seeing these transactional surveys. So you book a ticket, you get a little thing back that asks you 2 questions. Or you're part of a membership or something, and you get the survey that you have to complete. And all of those things are trying to understand you better. So there's even technology now that on Facebook it's sort of called stalking that you use. And what I do is I can go to a software provider that will combine your Facebook data with my information. So I can select, because I know who you are, I know what you like, I know where you live, I can actually decide who the people are that I will target my message to, and I can then customize my message to you. So that's where you start seeing these banner ads that somehow seem to relate to you, because we're using big data and combining it with these transactional surveys to understand our customers better. That's a massive growth area, by the way, especially in terms of digital. Because nowadays it's a lot easier to get that feedback than back in the days when you physically had to phone 1,000 people. And 900 of them would hang up the phone. The next thing is this executive digital. So suddenly we're seeing people sitting on expos that are digital or social media people. So this thing has become so huge that financial services companies are saying that if we don't understand this, then we'll lose. And when I say digital, it encompasses everything. So from your social media, your CRM, your MIS, your management information system. So do you actually understand which of your clients really support you and are profitable to your business? And putting everything together to get this sort of one view of client. Now, I don't really know of any business that has one view of their clients, especially the larger businesses, because it gets extremely complicated. And there's actually some legislation in place that does prevent you from just sharing people's information, across different platforms. So this is also a new role that's coming into the market that I think will be absolutely critical going forward. So if you don't have some sort of an app in the next year or so, the market will be operating 82% of those professionals have tablets. So if we're not communicating with people through that medium, it's a massive opportunity that's lost. Okay, so I'd like to thank you. I hope that's given you an overview of the whole financial services industry. So we do find some MBAs that come into the investment markets and try and make some money. It's not as simple as it seems, especially when the markets take a long turn. And I think there is going to be quite a bit of volume going forward, and it's been over the last 5 years or so. Okay, so what I'd like to do now is actually take some questions. If you have any specific questions about financial services, any roles that you might be interested in.
Give me a second, I can't help this. Not to spend the words in what you were saying. There was an article that I read yesterday about being asset managers actually not recruiting anymore because of the downturn in the markets or profits are not there, etc. So they put a freeze on recruitment. But the question is actually leading to, you were talking earlier about creating all these platforms and these lists and stuff like that. But if you work through all the job, the bottom line is it's layer upon layer upon layer and cost.
Yes.
Somebody's paying for that cost. And somebody's always the last guy to change, which is actually the client.
Yes.
Now, my worry about the financial services industry in general is that the FSBs picked up on it. And is this not a time bomb when it comes to this industry? Eventually, at some stage, somebody's going to say, you know what, yes, you're generating 3% return for it, but it's costing me 5%. So effectively, walk through with minus 2%. So it's not in my best interest. Is this, and that's what I'm getting to. So my question is, isn't this a bit of a time bomb that this financial services industry or profession is actually sitting on, that ultimately it's going to come to a point where we actually need to see a downturn before we're likely to see an upturn again? Just personally.
Yeah, I think that's fair. I think some of the pains already started to come into the industry already. I don't think it's necessarily a time bomb. I think the big focus in financial services is actually shifting away from what am I paying to actually what am I getting for what am I paying. So what people expected to happen in the US and the UK, post a regulator telling people that they're paying too much and the providers should stop charging for this, is people haven't necessarily stopped getting advice or stopped using platforms. What they've done though is they've said, I am willing to pay a platform that gives me the following things, the following fee. I'm not going to pay you a fee for all of this if I don't actually want all of this. So this whole one-size-fits-all thing is going out of the market. You have to be able to offer people modular things, because I don't want to pay for something that I'm not going to use. That's more or less on the platform side. But the platforms have been decimated. When I started working 13 years ago, we charged 1% initial administration fees, and we charged more than 1% ongoing administration fees. That's that part of the model. Today, there are no platforms that charge any initial administration fees. The fees are zero. And the average in South Africa is around 0.4% per annum that you pay for administration. Because the whole administration function has been commoditized to a point where people are just saying, well, I'm not willing to pay that fee anymore. So it's unlikely that that will go any lower, because in order for those companies to continue existing, they have to charge something. Okay? And there's a reason why they exist, because if you want to, no one buys just one manager. You actually want to diversify your portfolio. Now, if I told you you had to go and complete 5 application forms to get 5 different funds, it's no ways. So there is a function that they perform. They make it easier for you to access and diversify your portfolio. But you don't want to pay for all the other bells and whistles in your fund. So that part of the industry started playing. The next part, and that relates to the article that you're reading, is the asset management part. That is definitely, it's going to be challenging. I mean, in the US, there was a conference, a CFA conference recently, where they spoke about the death of active management, because there's just not enough active managers that are generating real returns or alpha returns. Now, in South Africa, it's been a little bit different. We've had some guys that have done really well. The question is, when the market turns, what will happen then? But like I said earlier, I do think that there are still some quality people. That it's the way that they charge fees. So the big thing on the asset management space that I think will come into threat, that we've already seen happen in the tax-free savings account, is the idea of performance-based fees. So they have prevented any manager from charging performance-based fees in the tax-free savings product. Because let's face it, I mean, the question we always ask the managers is, are you going to work harder for a performance fee than for a fixed fee? I don't know. I don't think so. Yeah, they make sense in the theoretical sense, performance-based fee. The better you perform for me, the more I pay you. That makes sense if the fees are symmetrical. So it makes sense if when you underperform, I don't pay you. But it doesn't necessarily work out like that in South Africa. They have base fees. You pay at least this, and if I do well, you pay me this plus 2%. So it's a, So I don't think it's a time bomb. I think it's about value. And like I said earlier, there is the shift from the product to the advice. Unfortunately, the advice part is relatively, I would say, underdeveloped in South Africa in terms of what they need to do in terms of representing the client. They're very well established in terms of selling product. And that's another big part that the regulator wants to get the teeth into. There are conversations happening now between the FSB, the Financial Services Board, and the industry around what we call these advisors. Do we call them implied, independent, what are they allowed to call themselves, and what determines what they are allowed to call themselves. This is all good stuff, because it will force people to actually show you the value that they can offer you.
Just to touch on that, the advisor, to me, it almost feels, I've got a lot of friends who's these advisors, but I mean, it's almost like they start a job and when something doesn't work out, they go do a CFP and then they become an advisor.
Yes.
They don't really have any clue. They've got the systems there, so they go and sit, put in the numbers and say, okay, we're going to do this and this is how it's going to work. So I think that really leaves a bad taste in many people. I mean, because you're working with these people and you're paying them and you realize that two years ago this guy was doing drama or whatever, now all of a sudden he's advising how to invest my funds. You're paying him for that. So that's really not a concern, because I mean, obviously those guys get worked out somehow, I hope. I mean, there's a lot.
Well, they haven't been, but they will be going forward. So there's a big emphasis on professionalizing that whole industry as well. So at least if they have a CFP, they have a fundamental understanding of the 6-step financial planning process.
So that's something.
If they, yeah, it's,
So anyone can get it if you sit and
you say that, but I can tell you something that they brought in these regulatory exams, which basically says that you have to understand the regulatory environment within which you operate if you're a financial planner. And they had two, one for key individuals and one for representatives. Do you know how many people battled to actually get to those exams? And it's unfortunately because the way the thing was structured in the past, it was heavily incentivized towards people that could sell. So if you were a journalist or a teacher and you weren't making good money, but you could get on with people, then you would go and be a financial advisor and actually didn't have to pass any exams. It's only since, I think, 2009 that they brought these things into place where you actually now have to go and qualify yourself. Now, it's not a requirement to even have a CFP. You can actually get credit for experience as well. Even though you need to have into level 5 within a certain period of time. But into level 5, that's not even on a degree level. So that is a big emphasis that they're focusing on as well. And I think what is going to happen is a lot of the people that work on the product side are going to go into the advice side and actually sort that out. Because I think people are going to come in that are well qualified, that are going to say, well, this is not the way things should be working, because it's a much better way of operating. So from an opportunity perspective, from a PPS perspective, that's a massive opportunity.
Yeah, I ask a question about, I don't work in financial services industry, I work in oil and gas industry. What do you look for to take in someone like an engineer or a geologist from a completely different industry and pull them into financial? What is that thing that you look for? Because that person doesn't come with obviously with experience in financial services industry or any financial experience. How did that person make the jump into financial services industry? What are the key triggers that you look for?
I think the important thing if you want to make that jump, and that's why I went through I put the personality stuff in this, make sure that the job you're applying for is somehow relevant. So if you have an engineering background, it will be very difficult for you to actually go and work in business development. But if you have an engineering background, generally speaking, a lot of quants people in financial services have engineering backgrounds. So I think it's important to position your experience in terms of the role that you're applying for. I think people in financial services are generally quite open. And I think often what happens, what seems to happen is that we don't actually see the right people. Because often the recruitment agents we work through don't understand that we'd be quite happy to take a guy with different experience and use them in our business. I mean, I'll be honest with you, we've been battling with finding people. You hear about there's a massive unemployment problem. Sometimes we feel like we sit on the other side where we just can't find enough quality people.
I came back from my work in Dubai at the end of last year. I came back at the end of last year. Applied for a lot of jobs. Right? I don't even get interviews. With a lot of experience with MBA in this business school. 10 years, 15 years experience after my MBA. I don't even get interviews. Promptly at the end of the day is to get a lot of contacts in the oil and gas industry to start on a business. Right? So I got something back to the oil and gas industry now. But at the end of the day, it's very uncertain environment that I'm in at the moment. So if I get a big project, it's nice. If I don't get a big project, it's not so nice. But so how do I make that step?
I think what's important is also the people that you are essentially employing to go and find something for you. You've got to be very careful of having too many people on board. So there are, I can think of 3 recruitment agencies in the financial services industry that most people use. You've got to be with them. If you're not with them, your CV is not going to find its way to the right people. That's the first thing. If that doesn't work, I mean, I'll tell you from a employer's perspective, I sometimes find working with recruitment agencies appalling, quite frankly. And they are quite expensive. So we are very keen to talk to people directly. And that's the other hint that I can give you is do not be afraid of contacting people in these businesses directly. Because you must remember, if you come to me directly, not through an agent, I say 15 to 30% the costs of what your cost to company would be. That's massive. So that's why PPS has set up this thing called Professionals Connect. It's a career portal, and what we're trying to do is leverage our access, our network, to get employers and graduate professionals looking for positions in contact with each other. So it's a new initiative. We have 11 stakeholders that have come on board, but we want to grow even more because exactly this issue is like who's taking up middleman. But there are 2 or 3 that I can recommend you that are good that you should go and talk to.
Sorry. Just to add on to the conversation, I think you're 100% right. This is actually good because 90% of recruitment agencies don't understand, they don't have a clue what you're talking about, so they don't know how to fit you in anything. But I think probably just to add on to another area you probably need to think of as well is getting into the asset management business as an analyst because you have something that a team actually needs. You understand angles as an engineer, as a geologist. You understand ground stuff inside underneath the ground. Your company doesn't. And this is where the role of an analyst actually becomes very important in the research capabilities. So you can look at Kuma, you can look at angles from a totally different perspective than the accountant will look at it. And I think that's really something as well. There's another career path, like outside of the finance background. I've spent some time in the asset management business, and that's why I work with engineers, I work with medical doctors, I work with guys with chemists and stuff like that as well. And these guys are very successful analysts within the asset management business.
But I think don't work on the assumption that the recruitment agent understands you or necessarily understands the employer. Because we often have issues where we realize after recruiting for months, we're not finding people because actually the agency doesn't really understand what we are looking at.
That's my conclusion as well. That's why that middle line in between is not. But the gatekeeper is keeping the right people from the right jobs. But it's also not easy for me as an individual to go directly to a business, to do eye contact with a business. I don't know the people inside. It's not presented on the website. Normally you'll go to HR function, and the HR function doesn't sustain either. The real requirement is to do the operations of the business.
I mean, it sounds a bit cheesy, but that positioning statement on your CV is quite important. if you are getting lots of CVs, it gets sort of hard to distinguish the one from the other. And what we often look for is you read the first 1 or 2 pages to get a sense of the person. And then, from there, you take it further. So that is fine.
Yeah, sorry, I just had a quick question. I think with customers being, or clients who have been more of this communication and feedback, I went quite well last week. You mentioned it earlier with my girlfriend, and have you noticed that customization is becoming more and more important? Like, so she kind of we left without having done anything because she started questioning how's money being invested. She's concerned about ethical investments and that sort of thing. Has that sort of started creeping into the industry?
Big time. Big time. So that goes to that whole modular thing. So it needs to be bespoke. And that puts the other point as well. So what you need to do is offer the client the menu, and then you get to choose what you want. So what I'm trying to do is facilitate the access and guide you in the thing that's most appropriate to you. But yes, it's a big thing. That also links to that customer experience manager, because we're trying to figure out what people in different market segments, what they want, so we can start customizing products in the broad sense of the word for them. Any other questions? Cool, thanks. Thanks, guys.
Okay, I just want to thank you for coming to share with us. It's been very interesting. I don't know much about the financial industry, so I found it very fascinating. Some of the questions as well. Thank you for taking the time.
Cool,
Appreciate it.
thanks.
Cheers.
So just one last thing, if you are interested, we specifically DPS do not yet talk about any product today. Our stand is there if you have questions about careers, you're more than welcome to talk questions.
And at the next working lunch, there's more time for ask questions and talk about it. Thank you very much.
Thanks.
Really appreciate it.
Yeah.
Yeah, let's do this.
Did you save it on the?
We just want to stop the sharing quickly.